Hello traders, Gary Wagner here just after 12 o'clock in Honolulu, 5 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands, November the 10th, 2017, and this is the daily report for gold and silver. A single order of 40,000 contracts of COMEX gold, 4 million ounces of gold, placed into the market today, sent shutters and caused gold pricing to plunge within a period of about 10 minutes, closing off of the lows but still closing under pressure, down $11.50, $12.76. Silver down about 9 cents, $16.88, and a muted dollar unchanged at 94.29. Traders, absolutely no doubt, gold was hit and hit hard today when at approximately 11:10 we saw this market drop about $10 without any cause in terms of a news event, a fundamental event, or economic data surfacing. In terms of figuring out the who, the what, the why, and the when, we still don't know the who or really the why, but we now know that it was a single sale of 40,000 contracts of COMEX gold that shook the gold market to its core today and resulted in a tremendous drop, as I said, in a time span of about 15 minutes. We're looking at a 15-minute candlestick chart, and we can easily see the net effect that this single sell had, not only in terms of a price drop, but in terms of a tremendous spike in volume this morning as this trade was executed. Currently, we do have gold trading off about $11.50 on the day at $12.76. We can see that reference with these last candles as we go into settlement. We did take a stab at the market yesterday going long above this price point. We did place our stops, however, below $12.72. The lows of the day came in at around $12.73. So we are going to go into the weekend with an active trade. Now, although we probably won't get the who for some time, as I said, we do know the what, we do know the when, and the why is quite obvious: to profit from that move. Someone had a large enough position. Some of the speculation right now is that it was a large hedge fund booking year-end profits, but the why is quite obvious because it benefited the trader who executed the trade. Nonetheless, we do have this market moving down in an unrealistic manner, meaning without a causal point behind it. So I would expect to see some support re-enter the market next week. I'm actually thinking about adding to our current position and cost averaging now that we've got a much better price to execute. We'll look at that on Monday morning. When we look at the market in terms of its recovery, again, we're looking at a 15-minute chart. We can see that the recovery was swift. It was fast, and the market quickly moved off of those lows. But as I said, this happened as we went into the close of market today. So in terms of time, we only had a couple of hours to see what the market was going to do immediately following this one price order. Now, the next question we really have to ask ourselves is, given what happened today, did that event cause any major technical chart damage? Well, it absolutely caused chart damage, but I'm not so sure it was major. First of all, we had been talking about the fact that we finally got a pop over the long-standing tight trading range that gold was in, with 62 at the bottom as absolute support and resistance at around 82. The fact that we broke out yesterday and the day before is what caused us to actually implement the long position in the market. Today's action puts us back squarely within the defined trading range. And that might, in fact, give us some insight as to why a trigger was pulled on that large of an order, simply because this was the first time we broke out of that range and a trader was able to take advantage of that. Now, at the same time, when we look at these series of lows that have recently come in, we can see that there have been a series of higher lows. Up until today, there was a series of higher highs. And my sense is that what we witnessed today is a one-day wonder, so to speak, in that come next week, we will return to a more composed trading style. And traders, the other fact that I really think we should be aware of and focus upon is, even with today's remarkable sell-off, dynamic sell-off, when we look at our 200-day moving average, and that is this green line here, we can see that even as this market dipped and broke below the 50-day moving average, it has for the last couple of weeks remained effectively above the 200-day moving average, which does bode well for the bullish faction. We're going to maintain our long position. We are taking some heat given that the market moved down substantially today. Keep your stop where it is, and as I said, I probably will look to cost average, effectively add to our current position on Monday. As we spoke about during the technical studies, it was a single trade or a single order that caused the devastating effect that we saw, in which gold dropped precipitously without any major event or shift in market sentiment. It is for that reason that during the show I talked about the fact that we want to try to use this to our advantage rather than being victim to it by adding to our current long position on Monday, depending on how the market opens. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.